single most important thing that's going to dictate where interest rates go this year is inflation. And there's some new data that's come out this week, and I'm going to explain to you and show you how the latest inflation numbers further reaffirm the view that the RBA is near peak rates and they're going to cut towards the middle or the end of the year. Now, inflation has been a problem 2021, 2022. It started to moderate in 2023, and it's in a completely different situation in 2024. The problem that we had with inflation towards mid-22 all the way through to 2023 is no longer at the extent to which it was problematic. The January inflation numbers have come out, and basically it shows that inflation is now at 3.4%. Now, this was the same rate as the previous month, 3.4% flat. So I'm going to show you how inflation is starting to really flatline and the components that are rising, what they are, and how they are likely to play out over the next 6 months or so. So the trend is definitely starting to come off the peak rates that we had. December 2022 was the peak, 8.4% monthly CPI indicator. And as you can see, we've been trending lower, and we're now just outside of the 2 to 3% target band range that the Reserve Bank sets. Now, there are different numbers. I'm going to quickly show you the numbers. We've got the headline CPI 3.4%. The seasonally adjusted number 3.6 was expected to be slightly higher, but the trimmed mean, and this is what the RBA looks at, the annual trimmed mean, as you can see, has come down from 4.6 to 4.0, 3.8, and it's going to start coming to the low threes, and eventually it's going to have a 2 in front of it, I believe, by this time next year. If we actually have a look at the components of inflation, so what's actually going up, food inflation was probably a little bit higher than expected, so that was a little bit surprising. If you actually have a look at alcohol and tobacco, that's flatlining. The thing about alcohol, tobacco is that it's government-induced inflation. A lot of the alcohol and tobacco components are driven by taxes and excises, which continue to go up. So that is very much a government-driven factor, not necessarily a demand factor. Food, clothing and footwear was relatively flat. Housing is quite strong. Housing inflation is still strong. It's still above 2 to 3%. And the main reason for that is rents. Now, the argument that I've made around inflation and services inflation over the past year or so is that the RBA's actions have made inflation worse in housing and in insurance and financial services. When interest rates start to rise, that makes the cost of building one house, hundreds of houses, thousands and thousands of houses more expensive. And because rising interest rates make property development and property construction more expensive, it is a very much an inflationary driver in the short term. So rents continue to be high because supply is low, and supply is low because the cost of construction, the cost of financing is high. So the RBA, if they do, and once they do start to reduce rates, I actually believe that this rents inflation will start to moderate over the next few years. We can also see that in terms of new dwellings purchased by owner-occupiers, that the inflation rate's starting to come down, but it's still above range. Electricity and gas starting to moderate, and a lot of other parts of the economy that are discretionary, particularly things like holidays, travel, and accommodation, are starting to come down. And that, to me, is echoed in the retail sales numbers. Rising interest rates are forcing people to pay off their loans, to meet their housing commitments, and to cut back elsewhere. And that cut back elsewhere in places like recreation, in places like holidays, in places like eating out, for example, that is going to really put a lid on services inflation. And I think we continue to find ourselves in a different situation towards mid-year with unemployment rising, the consumer tapped out, and the RBA having to move. One last thing that I want to point to is that insurance and financial services are very, very sticky above 8% inflation. And again, the insurance industry prices their policies based on the cost of money. And when interest rates are high, you're always going to get inflation in insurance premiums. The way to reduce inflation premiums is by reducing the cost of capital, the cost of debt, and that starts to come down when you start to cut rates. So more good news on inflation, a 3.4% rate, a seasonally adjusted rate, both combined that are slightly above the RBA's target band range. And what I'm going to show you next is the latest retail sales numbers. They have bounced, but they didn't bounce as hard as what some had expected, given the depressed levels that they were in the 2 previous months. Let's go and have a look at what consumers are doing in terms of their spending. Consumer spending did rebound 1.1% in the last month. So in January, we can see 1.1% bounce. And the bounce was expected because we had a prior month that was very, very weak. We had a prior month that was actually revised down from 2.1% to 2.7% decrease. So we have bounced. There's a bit of seasonality in there, but that bounce is probably not enough to offset this trend that I previously spoke about that's starting to build, and that is that the consumer is really starting to feel suffocated. As you can see, the consensus number, the market was expecting the bounce to be at 1.5%. We only had a 1.1% bounce. And so the consumer is really still under pressure. The consumer is spending, but nowhere near the level that they were spending a year ago or 2 years ago. And one of the things that we really need to keep in mind when we have a look at these consumer spending numbers is that the population has grown by so much. And when you strip out inflation, when you strip out the population growth, really the consumer is going backwards. Consumer spending is going backwards. We've built a case over the past few months that showed that the banks are reporting that their loans are being paid down, that loan obligations are not problematic, there's no systemic risk, and that builds a picture, a complete helicopter view for us that the consumer, households are paying off their rents, mortgage holders are paying off their obligations, and they are now starting to cut back everywhere else that's non-discretionary. Over the next few months, we're likely to see more non-discretionary spending come off the table, and I believe we're going to start seeing the unemployment rate go from 4.1% where it is into the mid-4s, and once it moves into the high 4s, that really will be the turning point. That, with inflation, is going to be the turning point in the tone and the commentary of the RBA. I still believe that that happens somewhere in the end of the second quarter or during the third quarter of this calendar year. We will continue to watch and see, and the impact for the real estate market is obvious. Property prices continue to consolidate. There is anecdotal evidence that the market is starting to heat up again into anticipation of interest rates moderating towards the end of the year. And the big factor for me for Australia, which hasn't been in this interest rate conversation to date, but I believe is very important, is what happens to China. Commodity prices are starting to moderate. And for Australia, that is super important. That will have a flow-on effect into our economy. And if commodity prices come off, if the Chinese economy doesn't rebound as hard, and if the consumer starts to slow down here in Australia, we find ourselves in a very, very different position mid this year than what we were mid last year or mid the year before when the RBA was hiking. The RBA is going to be watching this very closely, and I'm also going to be keeping a close eye on what happens to the jobs numbers at the end of this month when the number comes out over the next couple of weeks. If you find this analysis useful, if you find this helpful, please feel free to share it, subscribe, let me know what you think. And until next week, happy investing.